Hello everyone and welcome to the October edition of our monthly fixed income update. Yield curve dynamics first. The month of September saw a notable flattening at the ultra long end of the India's sovereign yield curve. While the 10-year benchmark yield closed largely unchanged, ultra long bond rallied, with yields dropping by 10 to 15 basis points across maturities. This contraction in yield spread was driven by confluence of factors, most anticipated but impactful nonetheless. The first key driver was shift in issuance calendar. The revised FY26 second half issuance calendar signaled a marginal undershoot in the issuance size versus a full year budgeted borrowing number. More importantly, the maturity distribution shifted meaningfully away from the ultra long bonds and towards the 3-year, 5-year and 10-year bonds. This was direct response to waning appetite among investors segments that traditionally are active in the ultra long space. Second reason was lower SGL supply. The SGL issuances for Q3 came in lower than feared. This improved the demand-supply balance and reversed the weak technicals that had plagued the market earlier. Third was monetary policy signals. The dovish hold by Monetary Policy Committee on October 1st opened the door for further easing. While the repo rate was held at 5.50, the tone was accommodative and the market began pricing in the additional rate cut. This led to broad-based downward shift in the yield curve in the first week of October. Overall, during the month, 2 policy meetings shaped the interest rate view for us and the market participants. FOMC in US delivered 25 basis point rate cut, bringing the target range to 4% to 4.25% for the policy rate there. Chairman Powell's tone was cautious, framing the move as risk management cut rather than start of a full-blown rate easing cycle. Despite upward revisions to the growth and inflation forecast there, the dot plot has shifted lower, reflecting a more dovish rate path. The second important meeting was RBI's MPC. The MPC maintained neutral stance but revised inflation forecast sharply downwards from 3.7% which we saw in June policy to 2.6% now for the year FY26. Growth projection for FY26 were nudged up to 6.8%, but RBI continues to anticipate a slowdown in H2 of FY26. The message was clear: while inflation is under control, INR stability remains the key anchor. In focus, there are some recent developments post these meetings. Since the FOMC, we have seen US government shutdown and a negative surprise in private payrolls data, both reinforcing the cooling labor market narrative there. This strengthens the case of deeper and maybe quicker rate cuts in US. Domestically, CPI inflation has rose but just to 2.1% in month of August as the base effect faded and food prices exited deflation mode. Core inflation remains soft at around 4%. Upcoming GST rate cuts are expected to further ease the CPI pressures. Based on these numbers and forecasts, looking ahead, the combination of adequate system liquidity and the remaining CRR cuts are expected to support monetary transmission. RBI's governor's statement had a notable mention where he said the growth continues to be below aspirations and pointed out significant moderation in inflation. By end of November, most of the impact of earlier 100 bips rate cut along with the fiscal boost will have played out, and we think there is a good possibility that this sets the stage for potential rate cut in the December policy meeting. To summarize, September was a month of recalibration of issuances, expectations and positioning. The market is now aligned with a more dovish trajectory, both globally and locally, but remains watchful of external risk and currency dynamics. Thanks for tuning in and see you next month.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.